Hey, welcome everybody to another edition of MFIS TV. Before we get started today, make sure you hit that subscribe button. We're trying to reach 1,000 subscribers. More and more of my clients and friends, parents are passing away. And recently I got a call the other day asking what is the taxes are going to be on the annuity once they inherited it because one of their family members passed away and they're one of the beneficiaries. Today we're going to go a little bit deeper, dig into that. What are the taxes on annuities once somebody passes away? Now, annuities, oftentimes you see a lot of seniors have them for a couple of things. The main one thing is that they want to guarantee lifetime income from it. And the second thing is the guarantees. Usually the second guarantees of their income, which no other financial instrument does, or they want the guarantees of the interest rate or the growth on that money. Now, annuities is a product, and there's then what we call a tax codes, which you can put the product in. I give the explanation of annuity is a car, and the go around it when you're parking your car is the garage. And the garage for the annuities, based on the taxation, can be three different ways it can be taxed. The first is qualified. It can be qualified in a qualified account, which means it can be in your IRA usually, or a 401k plan, or a 403b. If it's in a qualified account, that means this is in your tax deferred bucket. If you ever read my book, The Age of Self-Reliance, I talk about your tax deferred bucket. That means that money been growing tax deferred. We never pay tax. We got the deduction today. The money growing tax deferred, and Uncle Sam never got that money. So with that being said, what you're going to do is you're going to have to pay ordinary income taxes on that money. Now, a strategy that a lot of my clients have about paying ordinary income taxes on that, they be like, Jason, I'm about to receive 500,000. It's going to kill me in taxes once I receive my parents' money. And the strategy that we could do is we can make installment payments for 10 years on this money. So let's say you have $1 million you're receiving from your father or your mother. What you can do is you can take out $100,000 every year up to 10 years, then that money has to go away. Which now is you can be able to help you lower your taxable income on that, and even all your income that you receive from working. So that's an idea for you, and you can take out more as needed. So you want to buy a house, you see other investment options outside your qualified money, you can do it. The second bucket where it could be is in your tax-free bucket. And more importantly, when we say your tax-free bucket, it could be in a Roth IRA. Now, if the money is in a Roth IRA, that money has already been paid taxes on it. It's been growing tax deferred, but when we pull it out, it's tax-free. Now, with that being said, which is in a Roth IRA, your annuity could be it. So all benefits of this is going to be tax-free for you. Now, the last place that an annuity could be is what we call a non-qualified annuity. With a non-qualified annuity, which means that you didn't get the money didn't come from your retirement accounts like either one of these are. The money came from where you might have some money in the bank, you might have had it from the home, but you had some cash and you want to buy an annuity with it. And now the taxes of this is how they have it is you pay the basis or the amount that started open up the account, the amount you contribute, it's going to be all tax free. So let's go back to that $1 million example. This $1 million right here, you're going to pay taxes on the whole million. If it's in a tax-free bucket, that whole $1 million, even all the growth and everything, you're going to have to pay taxes. But let's say this non-qualified, you put $300,000 of it, you contribute towards it, or your parents contribute. That money's going to be tax-free, that portion. And then any gains you have on that money, you're going to have to pay taxes on it. Okay? So your cost basis is going to be tax-free, but any gains, you're going to have to pay ordinary income taxes. Not capital gains, but ordinary income taxes. Just want to break these down for you on how the taxes are broken into. This is just the basics of what are the taxes on your annuities once we receive it from our parents. As I see, many of us, our family members are getting older, and most of our parents won't be around for the next 10 to 25 years. Here's a better understanding on what's going to be the tax significance. You have any other questions, please let our topics you want to hear about, please let us know. Hit that subscribe button. And thanks again for subscribing to MFIS TV.